work in are increasing your cash flow, decreasing your debt, and reducing your taxes. We also like to let you know about annuities and life insurance, and trying to help you to become financially independent. That's pretty much what we do at ANCORA Financial. We're a company that's about 15 years old. We're in about 70 different cities, and what we do is help you and your family to retire as soon as possible. What does retirement mean to you? If you were to retire today, what would that look like? What would that mean?
Hopefully I'll be able to sit back, take it easy, and not worry too much about income and everything else.
Okay, so biggest thing would be income.
Right.
Is there anything else that possibly you and the wife might like to do in your retirement?
A trip here and there.
Okay. If you could take a trip today, where'd you go?
Oh, who knows? I have no idea. Probably just down to Florida.
Oh, out of Florida. Okay, or maybe Hawaii or something like that.
Possibly. I never had a desire that she likes it.
Have you thought about what age you'd like to retire?
I assume the standard is 65, 66.
If you could retire at 60, would that be okay? Or would that be something you entertain?
Well, yeah, as long as I can afford it.
Well, the whole idea is making your money work for you. And that's pretty much what we do at ANCORA.
Sounds good.
Now, Mr. Tucker, I want to touch on some of the issues and challenges that we have today. One of them is retirement. Any idea as to how many people are retiring every day at age 65?
Not a clue.
You'd be surprised. How many people do you think actually reach 65?
A lot of people.
Well, out of 100, only about 20 or 25 actually reach age 65. Somewhere along the line, they didn't make it. And out of 100 people that have turned 65, how many of them do you think are financially independent?
I would say about 10%.
So 10% would be 10.
10.
That would be a high number. Actually, it's only about 4 or 5 that are financially independent. And that's a crime, because what has happened today is there are no more pensions. People are now lured into 401ks and IRAs and Roths and things like that, but they're not pension plans, which means depending on the amount of money you take out of them each month, each year, they could run out. And of course, if there's a market downturn, you could run out even sooner. So the key is to talk and get involved with something that's going to last for the rest of your life. In other words, some type of pension. Now, Mr. Tucker, here are some solutions. There are 7 areas that we work in, helping to improve your cash flow, making sure you know exactly what you have by inspecting what you expect. Also, helping you get out of debt, improving your debt situation, making sure that you have emergency funds. Also, making sure that the amount of money you are putting in, you get the most with that money. That money is going to carry you through your entire retirement for the rest of your life. We want to make sure that that's the case. And we have 7 steps that we go over. Mr. Tucker, probably step 5 is one of our most important steps, because what we're doing is we're providing protection for you and your family. We utilize life insurance as a means happening, you certainly want to be in a position to help your family, whether you're here or not. And if you are here, you want to be able to have enough income so that you and your family can enjoy the fruits of your labor. Step 6 is probably the most important, because step 6 will change the quality of your life. And pretty much what we do at ANCORA is try and change the quality of your life. We try and get you to retire, maybe at 60, certainly by 65, financially secure. Now, can I be strong with you? There are 2 battles that we have to win. We have to win the battle of taxes, and we have to win the battle of inflation and volatility. One of these will not be enough. We have to win both battles. And if we do that, it will ensure that your family will be financially independent. Let me explain. One of the things we have to do so far as inflation is make sure you're getting a good rate on your money. Are you familiar with the rule of 72?
No.
Okay. Well, the rule of 72 means that if we divide an interest rate into 72, it'll tell us how many years before your money will double. So if we take 4% and we divide it into 72, it means it's going to take 18 years for your money to double. Looking at your age right now, I don't think we have that much time. But if we got a better rate of interest, then we could cut those years down. Let's say we got 6%. If we got 6%, then it would only take 12 years for your money to double. The types of programs that we get involved here at ANCORA, we're going to try and get you somewhere between 7 and 13%. If we can get you into the 9, 10, or 12% area, then it's only going to take 6 years for your money to double. So this is how we handle inflation. And as you know, inflation is growing at 2 or 3% a year. So any monies that you would have in some type of retirement program has to also include inflation. At the same time, it also has to include the fees and things like that you have to pay. So this is one area where we try and help with inflation. Mr. Tucker, let me I'll show you tonight how this rule of 72 actually works. Let's say you had $10,000 and you were getting 4%. Rule 72 says it's going to take 18 years for that 10,000 to become 20,000 at 4%. But we did it at 6%, then we know that it's going to take 12 years for it to become 20,000. But you're also going to be getting interest, additional interest and everything on that money at the same time. So the idea is, are you going to have 40,000 or are you going to have 640,000? And the bottom line is, so Mr. Tucker, the big question is, where can we get that rate of return on our money? Well, let's look at how we do this at ANCORA. Right now, if we took a fixed rate, then you would be getting somewhere around 2%, 3%. But we know that's not going to get the job done. Let's take a look at the stock market. Now, stock market has, you may be able to get a lot of money on the market, but you also have the opportunity to lose money. And that's really where the problem is in the stock market today. We take a look at the year 2000 and 2007, when the market did some very big downturns. A lot of people lost a lot of money. And you don't want to be in a position where there's volatility and you have the opportunity to lose money. There is a third strategy. It's called the index strategy. And pretty much at ANCORA, that's what we do, is we use the index strategy. Basically, we use the S&P 500. Now, historically, the S&P 500 over the last 25 years has averaged 10% a year. So there have been some good years and some bad years, but it's averaged over that time 10%. And the people that have had their money with this index strategy have not lost any money. Let me explain. Let's say you had $10,000 in year one, and it earned 10%. So the next year, you have $11,000. And let's say the following year, it earned another 10%. So now you have $12,100. So now, in that third year, the market tanked. It went all the way down, it lost 20%, and you were down to $9,600. But the people who were in the index strategy never lost a dime. They still had their $12,100. And that's the nice part about the index strategy is you can never lose your money because we have a zero floor. You don't participate in any downturns. You only participate in your money going up. So which one of these strategies do you think would be best for you?
No, index sounds the best.
The index strategy? Well, we think that that's the one that certainly will protect your money. And incidentally, the scenario I gave you with the market going up a couple years in a row and then going down tonight, that actually did happen. So now what happens is in that fourth year, if the market went up, then at $12,100, your money would go up. So if it went down again, you stay right where you are. So that's how it works, and we feel that that's a strategy where you can be comfortable and your family, you and your family, will not lose a dime. So Mr. Tucker, you can see why the index strategy has become the most popular strategy. And one of the things we are trying to do is win the rate of return and the inflation battle. So that you can get potentially high growth and protect your income from the downturn, market downturn. Let's say you wanted to get $1 million and for your retirement. So you went into the bank and you asked the banker, what would I need to do in order to have $1 million at retirement? So the banker would tell you, run the numbers and everything, and he'd say, you need $1,639 a month at 5% for 30 years. Well, you'd leave probably discouraged at that. But let's just say that instead of getting 5%, you could get 10%. Now, you would only need $900 a month for 30 years. And let's say we could move a little further, and let's say you weren't paying any taxes, so you could get a better rate of return. And let's just say that with not paying your taxes, you could get $430. You only have to put in $438 a month. Well, that might be a little better. That might be a lot more doable. So it's not a matter of what you start with, it's a matter of what you continue to do for, your time that you're working. so that when you get to your retirement, you're gonna be able to retire in comfort, retire in the style of which you become accustomed. That's probably the biggest thing. Now, Mr. Tucker, our last step, step 7, and that's the estate planning. And a lot of times, if we use a trust, then we avoid a lot of heartaches and tax consequences. And also, your family is going to be in a lot better position to take care of your liabilities. The importance of having a trust versus a will is making sure that everything that happens for your family and no one else can get involved. Basically, if you have a will and you pass, your signature dies with it. When you have a trust, you have your money in a safe, and you had the keys to the safe, and now you're leaving the keys to the safe to someone else, and basically they are able to go in and take care of your wishes, and do things the way you wanted to do. And Mr. Tucker, with the things that we've talked about today, what I'd like to do, with your permission, is get some information so that I can bring back some numbers and programs to show you exactly what we can do. Is that all right with you?
Yeah, sure.
A couple questions. If I can show you something that you would feel it's fantastic for you and your family, and felt that it met your needs, do you think we could do business?
I don't see why not.
Very good. And the other thing is, do you think that after talking with me today, that you would be able to recommend me to some of your friends, relatives? You'd be able to be willing to give me some numbers so that I could maybe call them and talk to them about what we've discussed, or some things like that?
I think I can do that.
Very good. Well, I appreciate that. So I'm going to be asking you some questions and getting some information from you. Basically, I want you to be thinking about what kind of numbers we could start with, I can show you. And on our second interview, second appointment, I can bring these numbers back to you.